Tax season isn't exactly anyone's idea of fun. But what's worse than filing taxes? Overpaying them. The good news is you don't have to spend hours sorting receipts to save money. The tax code is full of deductions available to anyone, no itemizing required. According to IRS data, about 90% of taxpayers claim the standard deduction. That's most people, yet plenty still miss out because they don't realize simple deductions are just sitting there, waiting to be claimed. If you're paying off student loans, saving for retirement, or donating to charity, there's cash hiding in your tax return. I'm here to show you exactly how to find it. In this video, you'll get straightforward deductions that actually save you money. No complicated strategies, just practical ways to cut your tax bill and keep more of what you earned. Before making any tax decisions, talk to a CPA who understands your specific situation and can confirm what applies to you. Saving on taxes is great, but doing it right is even better. Check out the full details by visiting the link in the description. Number 1. Student loan interest deduction. If you're still paying off student loans, the interest deduction is an easy win. It allows taxpayers to deduct up to $2,500 of interest paid on qualified loans, which can make a serious dent in taxable income. The best part? You don't need to itemize. If the loan was used for tuition, books, or other higher education costs, it qualifies. This deduction is especially useful for graduates early in their careers, when salaries are still ramping up and every dollar matters. The tax benefit phases out at higher income levels, but if you're eligible, this one is a no-brainer. Student debt is a burden, but at least this deduction softens the blow a little. Number 2. Health Savings Account, HSA, contributions. An HSA is one of the best financial tools available, and it comes with a major tax advantage. Contributions lower taxable income, grow tax-free, and can be withdrawn tax-free for qualified medical expenses. The contribution limit is $8,300 for families, and those aged 55 and older can add another $1,000 as a catch-up contribution. Since HSA funds roll over indefinitely, this isn't just a tax deduction. It's a long-term health and wealth strategy. People with high deductible health plans should be maxing this out every year. It's like a retirement account for medical expenses, except better because withdrawals for healthcare costs don't get taxed. Number 3. IRA contributions. Contributing to a traditional IRA is another way to cut down taxable income while preparing for the future. The maximum contribution for 2025 is $7,000 or $8,000 for those 50 and older. The tax deduction applies as long as income doesn't exceed certain limits, and the best part is that it reduces taxable income immediately while growing investments for retirement. Even small contributions today can compound into serious wealth later. Many people assume employer-sponsored plans like 401k are the only option, but an IRA offers additional tax benefits. If you're self-employed, between jobs, or just looking to maximize retirement savings, this deduction is worth claiming. Number 4. Self-employment tax deduction. Being your own boss has perks, but it also means paying both the employer and employee sides of Social Security and Medicare taxes. That's 15.3% of earnings straight to the government. To ease the sting, the IRS allows self-employed individuals to deduct half of their self-employment tax when calculating adjusted gross income. This lowers taxable income and helps offset the extra tax burden that employees with W-2 jobs don't have to worry about. Running a full-time business or just picking up side gigs, this deduction is essential for keeping more of what's earned. Number 5. Educator expense deduction. Teachers don't get enough credit or pay for the work they do, but at least they can get some tax relief for their out-of-pocket classroom expenses. K-12 educators who work at least 900 hours in a school year can deduct up to $300 for anything they personally fund to make learning better. If both spouses are eligible educators and file jointly, that amount doubles. It's a small deduction, but for teachers constantly buying materials on their own dime, every bit helps. Number 6. Qualified business income deduction. The QBI deduction is a game changer for freelancers, small business owners, and anyone with pass-through income. This tax break allows eligible business owners to deduct up to 20% of qualified business income, significantly reducing taxable income. It's one of the biggest deductions available to self-employed individuals and can result in thousands of dollars in tax savings each year. Not all businesses qualify and income limits apply, but those who do should take full advantage. With rising costs in nearly every industry, this deduction helps keep more earnings in the business instead of handing them over to the IRS. Number 7. Adoption credit. Adopting a child comes with emotional rewards, but it also carries financial costs that can stack up quickly. The adoption credit helps ease that burden. This credit covers qualifying expenses like legal fees, court costs, adoption agency fees, and even travel expenses for the adoption process. This credit is non-refundable, meaning it can reduce tax liability to zero, though it won't create a refund beyond what's owed. For families with multiple adoptions, the credit applies to each child, providing substantial tax relief. Adoption is a life-changing decision, and this credit makes the financial side a little less overwhelming. Number 8. Mortgage interest credit. Homeownership can feel like a financial mountain, but the mortgage interest credit helps lighten the load for low to moderate income households. This credit is designed for those who received a Mortgage Credit Certificate, MCC, through their state or local government, often tied to first-time homebuyer programs. Instead of just deducting interest, this credit directly reduces tax liability, which is even better. The credit can be up to $2,000 annually, depending on the percentage set by the MCC. Unlike the mortgage interest deduction, which requires itemizing, this credit applies no matter how taxes are filed. It's a smart benefit that makes owning a home more affordable, especially in the early years when interest payments are at their peak. Number 9. Retirement Savings Contributions Credit. Saving for retirement is already a wise move, but the Savers Credit rewards low to moderate income earners for doing just that. This credit is worth up to $2,000 for individuals, $4,000 for married couples filing jointly, and applies to contributions made to IRAs, 401k, and other retirement accounts. It's a double win, reducing taxable income through contributions and slashing tax bills with the credit itself. The credit percentage ranges from 10% to 50% of contributions, depending on income level. Many people miss out on this simply because they don't realize they qualify. For anyone building a retirement nest egg on a modest income, this credit is like free money for being financially responsible. Number 10. Military Moving Expenses Deduction. Active duty military members often face frequent relocations, and those moves aren't cheap. Thankfully, the IRS allows deductions for unreimbursed moving expenses incurred during a permanent change of station. This includes the cost of transporting household goods, travel expenses, minus meals, and storage fees. There's no need to itemize to claim this deduction, which helps military families dealing with the financial stress of relocation. Service members can even deduct expenses for moving a spouse and dependents. For those constantly on the move due to military orders, this deduction provides meaningful relief at tax time, recognizing the sacrifices made both personally and financially. Number 11. Jury Duty Pay Deduction. Getting summoned for jury duty is part of civic life, but it often comes with financial headaches, especially if an employer requires handing over that jury duty pay. Here's the silver lining. If jury duty pay must be repaid to an employer, that amount can be deducted from taxable income. While the pay itself is considered taxable income, this deduction ensures it doesn't create an extra tax burden. It's not a huge deduction, but it helps balance the scales for those doing their civic duty without losing out financially. Just make sure to keep documentation showing the repayment to the employer to back up the deduction if the IRS asks. Number 12. Gambling Loss Deduction. Gambling can be unpredictable, but the IRS offers a small consolation for unlucky streaks. Gambling losses can be deducted up to the total amount of gambling winnings, which helps offset tax obligations tied to big wins. This applies to everything from lottery tickets to poker games to sports betting. The key is solid record-keeping for receipts, tickets, and statements that prove both winnings and losses. While this deduction won't turn a losing year into a financial win, it does help reduce taxable income for those who've had a roller coaster year at the tables. Just remember, you can't deduct more than you've won, so it's not a free pass to bet the house. Before we continue with the video, take a quick moment to hit that like button and subscribe if you haven't yet. And don't forget to ring the bell for notifications so you never miss out on our latest updates. Plus, we've got some helpful resources in the description. Check them out and share your comments after you're done watching. Number 13. Alimony paid deduction. For divorce agreements finalized before 2019, alimony payments are tax-deductible for the payer. This deduction can significantly lower taxable income, offering relief to those making regular payments as part of a divorce settlement. The rules changed with the Tax Cuts and Jobs Act, so this only applies to older agreements. Still, for those who qualify, it's a valuable deduction that reduces the financial strain of alimony. It's crucial to differentiate alimony from child support, as child support isn't deductible. Proper documentation, like a divorce decree outlining the payments, is essential in case the IRS wants proof. Number 14. Casualty and theft loss. Deduction. When disaster strikes, the financial aftermath can be overwhelming. The casualty and theft loss deduction offers some relief for losses due to federally declared disasters, such as hurricanes, wildfires, floods, or theft events. This deduction helps cover the cost of property damage that insurance doesn't fully reimburse. The loss must exceed $100 per incident, and only the portion that exceeds 10% of adjusted gross income is deductible. This deduction won't erase the emotional toll of a disaster, but it can soften the financial hit. For those living in areas prone to natural disasters, understanding this deduction can make recovery a bit less daunting. Number 15. Health insurance premiums for the self-employed. Self-employed individuals face the full cost of health insurance premiums, but there's good news. Those premiums are fully deductible. This applies to medical, dental, and even long-term care insurance for the self-employed, their spouses, and dependents. The deduction reduces adjusted gross income, lowering tax liability without the need to itemize. This benefit is especially valuable for freelancers, contractors, and small business owners who don't have access to employer-sponsored health plans. The only catch is that the deduction can't exceed net self-employment income. For anyone running their own business, this deduction helps make health insurance more affordable in an already expensive healthcare landscape. Number 16. Penalty on early withdrawal of savings. Sometimes life throws curveballs, and dipping into savings early becomes unavoidable. When that happens, banks often slap on an early withdrawal penalty, especially with certificates of deposit, CDs. The silver lining? That penalty is tax-deductible. It doesn't matter how much or how little the penalty is. If it's listed on the 1099 INT form, it's eligible. This deduction directly reduces taxable income, offering a small consolation for accessing funds ahead of schedule. It won't erase the frustration of paying the penalty, but it softens the blow. The key here is making sure to report the penalty exactly as it appears on the tax document to avoid any hiccups with the IRS. Number 17. Lifetime learning credit. Education doesn't stop after college, and the lifetime learning credit rewards those who keep learning. Worth up to $2,000 per tax return, this credit applies to tuition and expenses for post-secondary education. Unlike other education credits, there's no cap on the number of years it can be claimed, making it perfect for working adults taking courses to improve their skills. The credit covers 20% of the first $10,000 spent on qualifying education expenses, which includes tuition, books, supplies, and even some course fees. Income limits apply, and expenses must be paid to an eligible institution, but for lifelong learners, this credit is a no-brainer. Number 18. American Opportunity Tax Credit, AOTC. The American Opportunity Tax Credit is one of the most generous education tax breaks, offering up to $2,500 per eligible student. Designed for the first 4 years of post-secondary education, this credit covers 100% of the first $2,000 spent on tuition, books, and supplies, plus 25% of the next $2,000. What makes it even better is that 40% of the credit is refundable, meaning it can boost a tax refund even if there's no tax liability. To qualify, students must be enrolled at least half-time in a degree program. This credit is a powerful tool for families with college students, significantly reducing the cost of higher education. Number 19. Military reservist travel expenses. Military reservists often travel long distances for training, and those costs add up quickly. The good news is that unreimbursed travel expenses for drill activities can be deducted. This includes mileage, lodging, and even meals while away for training. The deduction applies when travel exceeds 100 miles from home and requires an overnight stay. There's no need to itemize to claim this, making it an easy win for service members. For reservists balancing civilian jobs with military commitments, this deduction helps offset the financial strain that comes with travel obligations tied to service. Number 20. Contributions to SEP IRA. For the self-employed, contributing to a simplified employee pension, SEP IRA, is both a retirement strategy and a tax-saving opportunity. Contributions are tax-deductible, reducing taxable income for the year they're made. The contribution limit is generous up to 25% of compensation or $66,000 for 2025, whichever is less. This makes the SEP IRA an attractive option for freelancers, small business owners, and independent contractors looking to maximize retirement savings while lowering tax bills. Unlike traditional IRAs, SEP contributions can be made up until the tax filing deadline, including extensions, giving extra time to plan and save. Number 21. Health Insurance Premium Tax Credit. The Health Insurance Premium Tax Credit helps make health insurance more affordable for individuals and families purchasing coverage through the health insurance marketplace. The credit is based on income and family size, designed to cap the cost of premiums relative to income levels. Instead of waiting until tax season, many people apply the credit upfront to lower monthly premiums, but it can also be claimed at filing time if not used during the year. The exact amount varies, but it's significant enough to reduce healthcare costs dramatically. Just make sure to reconcile any advance payments with the final credit when filing taxes to avoid surprises. Number 22. Union dues. Deduction for certain employees. While the Tax Cuts and Jobs Act suspended the deduction for unreimbursed employee expenses for most workers, certain industries can still deduct union dues without itemizing. Armed Forces reservists can deduct dues related to reservist duties, qualified performing artists. Meeting specific income and work-related criteria may deduct union dues, and fee-basis state or local government officials can deduct dues related to their official duties. This deduction helps offset the cost of mandatory union membership fees, reducing taxable income and easing the financial burden for those who qualify. Number 23. Tax-free employer assistance for education. Employers offering educational assistance provide a hidden gem for tax savings. Employees can receive up to $5,250 per year in tax-free tuition assistance for courses for work or even personal development. This benefit doesn't increase taxable income, making it effectively a tax-free raise. It applies to undergraduate and graduate courses, covering tuition, fees, books, and supplies. Many companies offer this perk, but employees often overlook it. Taking advantage of employer-sponsored education assistance not only reduces out-of-pocket costs, but also helps advance careers without triggering additional tax liability. Maximize your tax savings. Taxes might be unavoidable, but overpaying is not. These deductions are simple, effective ways to keep more money in your pocket without the hassle of itemizing. Every dollar saved on taxes is a dollar that can be invested, saved, or spent on things that actually matter to you. The tax code is full of opportunities for those who know where to look, and now you do. Don't let tax season feel like a burden when it can actually be an opportunity to save. Take advantage, stay informed, and make sure every dollar works for you. Thanks for watching, and if you found this video helpful, don't forget to like, subscribe, and share it with your friends. Also, don't forget the link in the description.